bit of a rate increase environment that we've been weeks and months predicting, and it's upon us. Rates are getting into the high threes, low fours, depending on, the different loan products that you're doing. And I just wanted to go over a couple of tips to be able to minimize the damage, really, and try to get the best situation for your mortgage and your budget, and making sure that you're doing all the preemptive things before actually going and locking in a rate. When you're shopping for a mortgage, every time the rate changes an eighth of a point. So let's say you have 3.625 and it changes to 3.75. That's generally between an $18 and $25 change in the payment a month. So a half a point could translate to $100 or so. If it's a 30-year fixed loan times 360 payments, that's a decent amount of money increased in interest that you pay. One thing to keep in mind is that rates go up and they go down. So if you're in a high rate environment and you lock in a rate, at some point there's a strong probability that you'll be able to refinance and restructure that mortgage at a different time later. So it's not a forever thing. It's you can only control what you can control, and you really can't control rates. So, but what you can do is you can make sure that your application is in the best order in order to give yourself the best chance. So for one example is, depending on what loan product you're going for, you want your credit score in the A+ category, which really dramatically controls the rate. So if you're doing an FHA loan, you want to have your middle FICO score above a 680 to get access to the best rates. You could be a 681 or it could be an 801. Everybody in that realm for an FHA mortgage and a VA loan all get access to the best rates. For conventional loans, Fannie Mae and Freddie Mac, they want to see FICO scores above a 740. So they're much more particular about a buyer's FICO score for conventional loans to get access to the best rates. The next thing is, if you're in the market for a $300,000, $400,000, $500,000 house, whatever it is, pay attention to the mechanics of the house, the heating and boiling system, because if you see a house that's got an updated, high efficiency heating system, it could cut down on your monthly utility bills and really help out. Use LED bulbs instead of, regular light bulbs, because it does have a big impact on your utility bills, which will overall help you out with your monthly budget. So let's say you were pre-approved 6 months ago and the rates were 3.5. Check in with your loan officer to see where you're at now and if it puts you out of your budget yet or not. And if you're applying today and you're looking at getting pre-approved, don't be afraid of getting a quote with a high rate on it. And pad the rate, add another quarter point to the rate to make sure that not that you're getting taken advantage of by your lender, but make sure that if the rates do increase in the next couple of weeks and you haven't gone on a contract yet and you haven't locked in a rate, that you're still going to qualify if they go up. You want to make sure you have a cushion there. And that's a really smart thing to do. Another popular thing that comes back around when rates increase are adjustable rate mortgages. So when you have an adjustable rate mortgage, you have the initial rate when you lock in and close is at a much lower rate than the average 30-year fixed rate. And after the adjustment period, so if it's a 5-1 ARM or a 7-1 ARM or a 10-1 ARM, after 5 years, 7 years, or 10 years, depending on which adjustable rate mortgage you do, you'll have the initial rate, which will help out. And then after that adjustment period, it'll start to adjust and go up. So people will do an adjustable rate mortgage to get the lower payment, and then they plan on refinancing once it starts to adjust. So adjustable rate mortgages become much more popular in a high rate environment to keep the payment down low. And you can always consider paying points. It's not my favorite option. It's not what I recommend right off the bat, but paying a point will help get the rate down. And some people might need to do that in order to qualify for the loan that they want, because it'll make the debt to income ratio work.